Hey everyone, welcome back to Corporate Decoder, the place where we break down financial reports so you don't have to. Today we're diving into DHI Group Incorporated's 2025 annual report. Their financials are looking a little rough, so let's see if they can still find their footing or if it is time to say goodbye. If you love getting the inside scoop on companies, make sure you are subscribed and join our Discord community in the description below. So let's jump right into the heart of it, the financial tables. This is where the real story is. First up, revenues. For 2025, DHI Group brought in about $127.8 million. Now, that might sound like a lot, but it is actually a 10% drop from 2024, when they had around $141.9 million. That is losing roughly $14 million in sales. Ouch. And it gets tougher. They reported an operating loss of over $11 million in 2025, a big swing from operating income of about $6.3 million in 2024. This definitely shows they are struggling to cover their costs with the money they are making. Looking at the bottom line, net loss for 2025 was over $13.5 million. Just a year prior, in 2024, they had a small net income of about $253,000. That is a massive drop, going from a tiny profit to a significant loss. Interestingly, their adjusted EBITDA managed to stay steady, around $35 million in both 2025 and 2024. This metric excludes certain costs like depreciation and restructuring charges. While it is good they're managing these specific costs, it doesn't change the overall picture of declining revenue and a net loss. Adjusted EBITDA margin actually improved to 27% in 2025 from 25% in 2024, which suggests they are getting more efficient with the revenue they do have. Let's break down the segments. Clearance jobs actually saw a small revenue increase of about 1%. That is great news for them, bringing in around $54.9 million in 2025 compared to $54.1 million in 2024. This business is holding its own. But DICE, their technology-focused brand, took a big hit. Revenue dropped by 17%, from about $87.8 million in 2024 to just over $72.9 million in 2025. That is a $14.8 million fall-off right there. This points to a weakening in the tech hiring market, which is a major concern for DHI Group. Now, about those big charges, in 2025, they had a $9.6 million impairment charge on their DICE trademarks and brand name. This means they believe the value of that brand has significantly decreased. They also took a $7.8 million goodwill impairment charge for their DICE segment. This suggests that the value of the DICE business itself as an ongoing concern is less than what they originally paid for it or what it was carried at. This is a red flag indicating financial trouble or a serious shift in the business's future outlook. And then there are the restructuring costs, totaling $6.5 million in 2025, a huge jump from just over $1 million in 2024. This means they've been making significant changes, likely including layoffs to try and cut costs and streamline operations. Looking at the goodwill breakdown, the total amount has decreased from $128.1 million at the end of 2024 to $120.6 million at the end of 2025. This is mainly due to the impairment charges we just talked about and also the acquisition of Agileats, which added a small amount of goodwill. On the cash flow front, operating activities brought in a little over $21.1 million in 2025, which is pretty much flat compared to 2024. This means the core business is still generating cash, but it is not growing. Financing activities used about $13.2 million in 2025, mainly for stock repurchases and paying down debt. They bought back shares worth nearly $10 million and paid down $8 million in debt. This shows they are trying to return value to shareholders while also managing their debt. Let's quickly look at their lease obligations. They have about $9.2 million in future operating lease payments. This is mostly office space, and with all the restructuring, it makes sense they might be reducing their footprint. DHI Group also has some investments. Their stake in Financial Careers, which is based in the UK, is valued at about $1 million at the end of 2025. They had to take a $0.9 million impairment charge on this investment in 2025, showing that even their smaller investments are facing challenges. Now, let's talk about their stock. As of the 31st of December 2025, they had about 44.4 million shares outstanding. The stock price has been quite volatile, with the performance graph showing a significant drop since late 2020. This volatility is reflected in their earnings per S-share. For 2025, they reported a loss of 30 cents per S-share. This is a stark contrast to the 1 cent per S-share profit they had in 2024. So what is the story here? DHI Group is in a tough spot. Their DICE segment, which is supposed to be their tech-focused growth engine, is declining significantly. Meanwhile, their clearance jobs segment is holding steady, but not really growing fast enough to offset DICE's slide. The impairments and restructuring charges point to a company that is struggling to adapt to current market conditions, especially the softening tech hiring market and the impact of AI. They are trying to be efficient, as shown by the improved adjusted EBITDA margin, but revenue is falling, and they've swung from a small profit to a notable loss. The risks mentioned in the report, like competition, AI's impact on tech jobs, and economic downturns, are very real and seem to be playing out. While they did acquire Agiliates to strengthen clearance jobs, it is a small acquisition in the grand scheme of things. The company is trying to manage its debt and return cash to shareholders through buybacks, but the declining revenue and profitability raise serious questions about their long-term strategy, especially with their heavy reliance on the tech sector. It feels like they are in a defensive position, trying to cut costs rather than aggressively pursuing growth. The conclusion is that DI Group is facing significant headwinds. While clearance jobs is a bright spot, the struggles at DICE are a major concern. Investors should watch closely to see if their restructuring and focus on efficiency can turn the tide. Or if this is a slow decline, it is a company trying to navigate a challenging market, and right now the challenges seem to be winning. Alright, that is our breakdown of DI Group's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.